Good morning, everybody. My name is Harshita Vyas, and I am Assistant Professor in Rai School of Management Studies, Rai University. So, today my topic of discussion is sources of finance. So, quickly we'll move on to why do we need to study finance. So, as Dun& Bradstreet has mentioned, that almost half of all the ventures fail because of poor financial management, because even if it's an individual or a firm or any type of business organization, managing finances is of utmost priority, and if in case a person fails to do so, the individual can also face problems, and with respect to business organization, they can run out of business. And now, what is a source of finance? So money is of utmost need in order to survive and keep the business running. So sources of finance is a method of acquiring, raising the money, capital for keeping the business intact. So it's quite simple. From where you will be getting or raising or deriving or procuring funds, that is known as sources of finance, and it has been classified in three types. It can be classified on the basis of time period, ownership and control, and sources of generation. So we'll quickly move on the basis of time period. So there are three types of sources of funds in time period, which is short term, medium, and long term. 2 3 must have been included in maybe two or any one or any three of these. So I'll explain it to you, and then we can use it whenever needed as per the question context. Now, short term sources funds are that those are usually with less than 1 year of maturity, and it is majorly used for working capital requirements. So, working capital deals with your day to day operations. So, for that, any business organization requires short term sources of funds. It can be bank overdraft, it can be bank loan, leasing, credit card, trade credit, bill discounting, letter of credit, and factoring. Now, bank overdraft is a facility that a bank provides to business organizations. It can be given to individuals as well. So there, what happens is the overdrawn amount. So bank gives you a limit with up till which you can withdraw the money from your account, even if you don't have that much balance available in your bank account. So the overdrawn amount, it depends on the needs of the business at the time and its credit standing, right? Now, interest is also calculated from the time from which the accounts has been overdrawn. So bank overdraft is the first type of short term sources. Another is bank loan. So bank loan can be various bank loans. It totally depends on the time period. If a bank loan is for a year or so, it will be known as a short term bank loan. If it is for more than 5 years or up to 5 years, it can be known as a medium term bank loan. And if it goes ahead of 5 year and it goes up till 20, 25, 30 years, it will be known as long term bank loan. So bank loan is a amount that any business organization takes as a loan, and in exchange of it, they pay interest to the bank, and it is required that in a bank loan there is a rigid agreement that is there, which happens between the borrower and the bank. The borrower can be the business organization, and the borrowed amount has to be repaid over a certain period or on the basis of regular installments. Sometimes the bank can also change the persistent overdrafts that are there, and so the borrowers must repay at regular intervals. Another type is leasing. So leasing, you can understand as the name suggests only, the leasing allows businesses to buy plant, machinery, equipments, or anything which is required for day-to-day operations. In this, you don't have to pay that much amount immediately. You can lease that particular asset or the requirement that you have at the moment. Then the leasing company or the bank hires, they buy the equipment for the use from the use of the hire company who's using it for a certain period of time. And if the user can own the equipment, it is called an it is called an operating lease. Whereas if it is given to the choice to own the equipment at the expiry time, then it is known as financial lease. So if you are owning it before the expiry time happens, you will be going for the financial lease option. And if you are not owning the equipment, it will be operating lease option, right? And the lease payments are made by the hire company on monthly or quarterly or yearly basis. Then another short-term source is credit card. So this we all know about it. All individuals also use it depending upon their needs and necessities. So these cards are used for multiple uses. The major reason behind usage of a credit card is to not to worry about how much balance is left in your account. You can use up till a credit limit that has been given by the bank, and you have chosen that for yourself, and for that you have to pay the interest over that once you get your credit statement at the closure of every month. Now cards, they may also not be these cards can be said as they are not so suitable for certain purchases as well, especially for a large sum of order, because credit limits are not that huge generally. And then there is another option which is trade credit. So it is a common method of business operations, where business organization, they buy materials and they pay for the same at a later date. Usually that date varies from 30 to 90 days. So such is the trade credit, which is given by the seller, is usually for a free of interest charge, right? It is known as short-term financing. Then another type is purchase or sale bill discounting. So let's understand, under this, a bank takes the bill that is drawn by the borrower on his customer, right? Let's say X is the borrower and he has taken the bill. Bank is another entity who has taken the bill from Mr. X to collect that bill from Mr. Y, who has to pay to Mr. X. Then bank pays after deducting that amount, because Mr. X has taken the money from the bank after representation of that bill discounting. And when the date that is written on that bill becomes due, they will go to Mr. Y, present the bill, and they'll get the money. The bank will get the money from Mr. Y. Now let's understand in terms of figures. Mr. X has to collect 10,000 rupees from Mr. Y. Mr. X has gone to the bank and has presented the bill and taken, let's say, 9,600 rupees, because they want the liquid money immediately, right? Now the bill is with the bank, and the bank will go to Mr. Y after 30 days when the date is due on that bill, and will collect 10,000 rupees. So the 400 rupees is the interest that the bank has earned for paying the money immediately to Mr. X. So this is all about bill discounting. Now there is letter of credit. So letter of credit is a document which is issued by the bank at the request of an importer or purchaser. The bank also promises to pay an exporter upon the presentation of the documents that are specified in the letter of credit. And letter of credit also reduces the risk of non-fulfillment, because the bank agrees to pay against documents. And the letter of credit must contain a specified validity date and a stated maximum amount. So this is representation of all that I have talked about. So issuing bank is there, beneficiary who is the exporter, then applicant who is the importer. So the relationship between the issuing bank and the exporter is governed by the terms that are written in the letter of credit, and the relationship between importer and the issuing bank is governed by the terms of application and agreement. And the relationship between beneficiary and, that is, importer and exporter, is governed by the sales contract, because the sales has happened between exporter and importer, right? Then The last type is factoring. Factoring is a financial transaction, and it is also a type of debtor finance in which a business sells its account receivable, right, to a third party who is known as a factor at a discount, and an agreement in which receivable arising out of sale are sold by borrower to the financial intermediary at a discount. And a business will also sometimes factor its receivable assets to meet its present and immediate cash needs. Factor is concerned more with the credit worthiness of the party invoiced than the client's financial status. Because why they say that they are interested in the credit worthiness? Because when a business organization is giving its accounts receivable to a third party, it will definitely going to have an investigation check on the credit worthiness of that company. So there is no wrong in taking credit, but it's really important that you repay on time, because it builds your goodwill and your credit worthiness, which will help you in raising money in the future. Again, this is a basic difference between factoring and invoice discounting. So you don't have to confuse yourselves. With invoice discounting, a company always asks for a loan and uses its accounts receivables as a collateral. But with factoring, the company sells its account receivable. So this is a basic major difference. Okay, now we'll move on to the medium term sources of finance. So it is preference share capital, debenture, medium term loans, lease finance, and hire purchase. So loans we have already discussed. It depends upon the tenure, the time period for which a loan has been taken from the bank. So it varies. In short term, it can be up to 1 year. So that is why it is known as short term. So we'll start with preference shares. So as the name indicates, it's preference share. So the people who own preference shares in any company, they have certain privileges or the preferential right to that is attached to them as compared to the equity rights. In this, the shareholders of preference shares, they carry a preferential rights again for the payment of dividend during the lifetime of the company, and also in case of winding up of the company, they get a preferential right over the equity shareholders. And a preferential right as to the return of capital, already that I have mentioned a minute ago. Then another type is debentures and bonds. So debenture is also included in long term. We'll study it again. But usually bonds are known as medium term sources of finance. So debenture represents the borrowed capital. It always comes under the liability, not in assets. So debentures represents the borrowed capital. And these people, the debenture holders, are known as the creditors of the company, and they get a fixed rate of interest. So if we talk about equity shares or preference shares, these people get dividend and debenture holders get interest. Bond is also a debt security where the company borrows money and issue bonds against the evidence of debt, and it is a fixed charge. It must be paid even when the company has not earned profits. Another type is hire purchase. So this is a transaction in which goods are let out on hire with option to the hirer who has taken it to purchase with the following condition. And those conditions are payment made in installment over a specified period. So regular payments of all the installments. Possession given to the hirer at the start of contract. So in the beginning only you have to let them know that they have taken the possession. Title of the assets passes to the hirer on payment of the last installment. So once a hirer completes all its installment, they become the owner of that particular asset. Each installment is treated as hire charges. If there has been any default in those payment of installment, the seller is entitled to take away the goods back. Hirer is also free to return the goods without being required to pay any further installments. Now we'll move on to long-term sources of finance. So share capital, equity shares, preference share capital, retained earnings or internal accruals, debenture, term loans. Term loans is against the bank, again the bank loan, which goes on for a period of long time, maybe 15, 20, 30, 35 years. Venture capital, international financing. So we'll start with share capital. It is also, so the capital that any company raises from the general public is known as the share capital, and the capital of the company is divided into shares. So each share forms a unit of ownership of a company. Equity shareholders are known as the owners of the company, and they also have a voting right attached to them. Preference shareholders, they don't have any voting rights. Neither preference shareholder has nor debenture holders has. Only equity shareholders has the voting right, and they are known as the owners of the company. Now equity shares are also known as ordinary shares, and there are two important features of equity shares. The equity shareholders, they do not enjoy any preference in getting the dividend, and they do not have a priority of payment of capital at the time of winding up of the company. So you can just relate to what is visible to you on your screens, that is preference shares. I have explained it to you. Preference shareholders, they have a preferential right for receiving the dividend during the lifetime as well as during the winding up of the company. Now another type was retained profits. So as the name suggests, retained profits. So any company in this world which has earned profits during any financial year, they resist from distributing the entire amount to their shareholders, right? Why they do so? Because to make a reserve, to make a retained profit reserve, which they might use it in the future. So it is also known as an internal type of sources of finance, where a company raises funds by making reserves, right? For example, if we take an example of an individual, so what do? They earn money. They might do a job, they might do any business or be an entrepreneur. So if they earn money, they will not spend the entire thing on the business. They might save some money for themselves, right? So this is what a business organization does, right? Just the scale is different. Nothing new or rocket science is here. So retained profits are the earnings of the company which are retained in the business, and it is the sum of all the total profits which is accumulated. So इकट्ठा करते रहते हैं वो लोग. So they keep on accumulating it and collecting it so that it can be distributed later as dividend, or it can be used later for the utilization in business itself. This is retained profit. Retained earning is also another name for it. Now the debentures, we have already discussed it. Borrowed capital, they are the creditors of the company. Yeah, and that interest rate can also be fixed or it can also be floating rate here. Term loans, we have already mentioned. Long-term debt with a maturity of more than 3 years. So any time period above 3 years is a term loan. Then loan against property. So as the name suggests only, whenever any business organization avails loan from the bank against a property, so the property that you keep as collateral is loan against property. Quantum of the loan depends on the type of the property and income of the borrower, right? Then the tenure is flexible. It can be from 3 to 7 years, and the interest rates vary from 11 to 14%. Venture capital, it's one of the most prevalent type of sources of finance used in long term. So any young private company which is not ready or willing to tap the public financial market. So public financial market is when a company goes to general public public in raising the capital from market. So whenever a company is not ready for such a step, they seek for venture capital. Venture capital funds seek to support growing firms during the initial stages before they are ready to make the public offering. So you see, like these days, when Paytm 197 Communications has come with the IPO, before that it has been a bootstrapped company, and then this has gone for venture capital. So similarly, Nykaa, as you see, Nykaa's IPO also came much later after it has started its operation. So they have also went for venture capital option. This is provided mainly in the form of equity capital only. Right? These are some features. It talks about that venture capitalist, the people who are investing in your business, they are inclined towards a high risk. Then it subscribes to the equity as well, and also the financial burden from the assisted firm tends to the to be negligible in the first few years, and the people who are investing in your business, they might be given maybe equity shares in your company at a later stage. And there are various stages also in venture capital financing. It can be early stage, it can be during expansion phase of any business organization, for acquisition or buyout option as well. This was the last external commercial borrowings, which is the last type of long term. So here a foreign currency loan in the form of bank loan is taken, where the securitized instruments are availed by residents from non-resident lenders with minimum average maturity of 3 years. So 3 years is basic. For that you have to take it. Now the Department of Economic Affairs and Ministry of Finance are the people who are regulating it, and foreign currency convertible bonds, preference shares are governed by the ECB guidelines. So these were a few types. Now the conclusion part is that deciding the right source of finance is crucial in order to help the business grow and sustain. An incorrect source of finance will increase the cost of funds, which in turn would have a direct impact on the feasibility of any business. So thank you. This was all for this topic.